Insurance is a foundational cornerstone of an estate plan and is key to an effective and efficient comprehensive legacy management strategy. Where estate planning traditionally focuses on the distribution of assets, a comprehensive legacy management plan develops a system to create, grow, preserve, protect, and then eventually distribute assets acquired over one's lifetime. Life, personal property, real property, medical, and disability insurance are vehicles that can provide a platform for all of the components of comprehensive legacy management. Let's take a closer look at each. Life insurance serves as a fundamental tool in estate planning, acting as a crucial hedge against the untimely death of an income earner. Its primary role is to prevent a potential shortfall of resources by providing essential estate liquidity in a timely manner to meet obligations that arise at death. This strategy is particularly vital for two key groups: individuals with estates that may exceed the applicable estate tax exemption amount, and those who have not accumulated sufficient financial resources to fully fund all of their estate planning goals for their beneficiaries. The objectives for incorporating life insurance into an estate plan are diverse. It is primarily used to protect the income stream for surviving family members and can serve as a dedicated source of funds for a child's education. A core function is to provide immediate liquidity to settle debts, taxes, and final expenses. Beyond pure protection, it can also be a source for retirement income, a means to create or sustain family wealth across generations, and a reliable funding mechanism for buy-sell agreements that govern business succession. Understanding the parties to a policy is essential. The owner is the person or entity who holds title to the policy and maintains control over its terms. The insured is the person whose life is covered by the contract. The beneficiary is the person or entity entitled to receive the death benefit upon the death of the insured. There are several types of life insurance, each with distinct characteristics. Term insurance provides a pure death benefit if the insured dies within a specified term. Universal life is akin to a term policy, but includes a cash accumulation account, offering flexibility in premium payments. Variable universal life allows the owner to direct how the cash value is invested, though it does not provide guarantees. Equity-indexed universal life links the growth of the cash value to a specified market index. Whole life provides a guaranteed death benefit for as long as the policy owner pays a fixed annual premium. Finally, second-to-die insurance, often used in marital estate planning, insures two lives and pays the death benefit only upon the death of the second insured. The income tax treatment of life insurance is multifaceted. Premiums are generally not tax deductible, with an exception for employer-paid group term insurance. Crucially, the death benefit itself is generally received by the beneficiary free of federal income tax. During the insured's lifetime, accessing policy values has tax implications. Cash surrenders are tax-free up to the owner's cost basis. Policy dividends are generally considered a tax-free return of premium. Withdrawals are treated as a tax-free return of basis first, with any excess being taxable income. Policy loans are also typically tax-free unless the policy lapses with an outstanding loan. Special rules apply to modified endowment contracts, which are policies deemed to be overfunded. Loans and withdrawals from MECs are taxed less favorably. Tax deferral is available through Section 1035 exchanges, which allow for the direct exchange of one life insurance policy for another without immediate tax consequences. Furthermore, accelerated death benefits allow a terminally or chronically ill insured to access a portion of the death benefit tax-free. Life insurance transactions can also have gift tax consequences. Making an outright gift of a policy itself is a present interest gift, which can qualify for the annual gift tax exclusion. Gifts of cash intended for someone else to pay premiums are also considered gifts. For federal estate tax purposes, life insurance on the decedent's life is included in their gross estate if they held any incidents of ownership in the policy. The 3-year look-back rule further states that if an individual gifts a policy on their life within 3 years of death, the death benefit is included in their estate. To avoid estate taxation on life insurance proceeds, an irrevocable life insurance trust or ILIT is often used. The ILIT is designed as the owner and beneficiary of the policy, so the proceeds are not included in the insured's estate. To make contributions to the trust for premium payments qualify for the gift tax annual exclusion, crummy powers are used, giving beneficiaries a temporary right to withdraw the contributed funds. Other objectives of an ILIT include providing liquidity to the estate by granting the trustee the power to loan money to the estate or to purchase assets from it, thereby infusing it with the cash needed to settle taxes and expenses. Personal asset and property protection is essential to maintaining a prosperous, thriving estate. From its very inception, your estate is at risk of diminution and complete destruction from lawsuits, accidents, illness, and plain bad luck. Proactively securing the appropriate insurance policies is an indispensable strategy for protecting all aspects of your estate, which include your assets, your property, your person, and your ability to earn an income. Personal property includes your movable possessions, such as vehicles, jewelry, electronics, and art. The primary risks here are physical loss or damage from accidents, theft, fire, or natural disasters. For example, a car accident can result in a total loss of your vehicle and create significant legal liability if others are injured. Similarly, a burglary could wipe out a lifetime collection of valuable heirlooms. Insurance serves as a direct protective option here. Auto insurance is legally mandated to cover vehicle damage and liability. Homeowners or renters insurance provides a broad shield, covering the contents of your home against a wide range of perils. For particularly valuable items like fine art or jewelry, specific asset insurance, often called a floater or rider, provides dedicated coverage beyond standard policy limits, ensuring a high-value piece is fully covered if lost or stolen. Real property refers to your immovable assets, your home, rental properties, and land. These assets are exposed to risks that can lead to massive financial loss. A house fire can destroy the structure itself, a severe storm can damage the roof, or a visitor's injury on your property could lead to a devastating lawsuit that places a lien on your home. Homeowners insurance is the cornerstone of real property protection, covering the physical dwelling structure against disasters and providing liability coverage for incidents that occur on the property. This ensures that a single accident doesn't force you to liquidate the asset to pay a legal judgment. For landlords, specialized landlord insurance performs a similar function for investment properties. Intellectual property, or IP, includes intangible creations like inventions, literary and artistic works, designs, and trade secrets. The risk here is not physical damage, but rather misappropriation and infringement. A competitor could steal your patented product design, someone could profit from your copyrighted work without permission, or a former employee could disclose a crucial trade secret. The loss of IP can destroy a business's competitive advantage and its primary source of revenue. While specialized IP insurance exists, the first line of defense often comes from liability insurance. For a business, a general liability or professional liability policy can help cover the immense legal costs of defending against an infringement claim, whether it's valid or not. This protects your other assets from being drained by a protracted legal battle. Finally, the most valuable asset in any estate is you, your health, and your ability to earn an income. An illness or disability can halt your income stream, while a medical emergency can generate staggering bills that decimate your savings. This is where medical insurance is critical, shielding you from the full cost of health care. Disability insurance acts as a paycheck protector, providing replacement income if you are unable to work due to injury or illness. For foundational support, government plans like Social Security provide disability and retirement benefits, forming a safety net beneath your personal insurance. A critical application of life insurance is funding buy-sell agreements. These are legal arrangements that require the sale of a business interest upon a specified event, such as an owner's death. Their purpose is threefold: to ensure an orderly transfer of control, create a market for otherwise non-traded stock, and provide liquidity for the deceased owner's estate. There are several types of these agreements. An entity purchase agreement obligates the business itself to buy the deceased owner's interest, though it can disadvantage surviving owners by not increasing their tax basis. A cross-purchase agreement involves the individual owners, who each purchase insurance on the lives of the others. This allows survivors to increase their basis in the business and avoids potential corporate accumulated earnings taxes. A one-way buy-sell agreement is designed for sole proprietors or single shareholder corporations. A wait-and-see buy-sell agreement offers a hybrid approach, giving the business the first option to purchase, then the surviving owners, combining simplicity with tax advantages. Life insurance is considered the perfect hedge for a buy-sell agreement triggered by death, as the proceeds provide the cash needed to execute the purchase. The appropriate type of policy depends on the situation. Permanent insurance, such as whole life, is suitable for family-owned businesses or long-term relationships, as it provides guaranteed protection. Term insurance may be adequate if the agreement mandates a sale at a particular age. For the price set in a buy-sell agreement to be accepted as the estate tax value, the agreement must be a bona fide business arrangement with terms comparable to an arm's length transaction. In conclusion, a comprehensive insurance portfolio is not an expense, but an investment in the stability and longevity of your estate. By strategically using life, auto, home, liability, disability, medical, and specific asset policies, you build a defensive wall around everything you've worked hard to build, ensuring that a single unforeseen event does not lead to its financial destruction.